That's the mistake. The mistake is thinking that you can make money at this by having a high win rate, high frequency, low reward to risk strategy. That's the whole deal. I mean, that's how I see it anyway.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome back to Two Traders. It's Walter Peters here. I've got Darren on the line. Hello, Darren.
Evening, Walter.
Yeah, so Darren, we're going to talk about comfort in trading and why it is that we tend to be attracted to comfortable things, why we probably shouldn't do everything that's, and I'm guilty of this. I talk a lot about how you need to trade your beliefs as a trader, but one of the things that you brought up in our last episode was how important also to give yourself a little bit of a push, and there are some elements of your system that should really be uncomfortable, and I think this is a really good idea. So let's dig into this. So what do you mean when you say you need to know what kind of trader you are and how you should trade, and what's attractive to you as a trader, but also having elements that are uncomfortable? What does that mean to you?
Yeah, I think the first thing you need to consider are our biases, our cognitive biases, the way we react to certain things, not just in trading, but in life in general. These biases, we all have them, some to a lesser degree, some more extreme. And when you look at the mistakes that traders make and the reason that most traders lose money over time, you can see that these biases that we have, they come to play in a big way. The danger when trying to fit a trading strategy to your personality is, over time, you tend to change the elements of the strategy so they feel comfortable, in the belief that what you're doing is trading your personality. So, for instance, you could say, I don't like scalping, and then you would adjust your strategy based on that. But I feel that whatever style of trading you pick, there's going to be elements that feel uncomfortable, and an ability to deal with those uncomfortable elements, I think, is really where the difference between winning and losing as a trader lies. I think in sport as well, you kind of get this when you listen to people who are successful in sport, they kind of develop this ability to just kind of go through the pain level at the points where maybe some of us would give up. Or there's like football teams that even when it seems like everything's lost, they kind of have this ability to stay calm and go through the processes, and they always seem to come back and win. I think that's why we always lose to Germany in the World Cup. They've just got better psychology as a team. They've got this ability to deal with those uncomfortable moments, and I think if you always tweak a strategy so it feels comfortable to you, essentially what you're doing is you're making trading more human, if you like, and I think it's those abilities to deal with those uncomfortable elements that really make a difference.
Yeah, and I think, like, if you think about it, here's the reality. The reality is that most traders would like trading to be like their personal ATM. They flip open their laptop, they sit down, and they punch a few buttons, and then boom, the cash spits out. I mean, that's like, that's the reality. That's what traders want. And then they want to tell their boss to screw off, or they want to buy a nice car, or they want to travel, or whatever. But it's because they can flip open their laptop, make a couple of decisions, and pull out some money. That's kind of like the dream scenario for trading. So if you look at it, and I think most traders are drawn to trading with kind of that in the back of their mind, whether they admit it or not, right? So, and I could be wrong, but that's what I think. Okay, now the interesting thing about that is that, if you're trying to map that onto a trading style, scalping would most closely be associated with that style of trading, because you sit down, you pump out some trades, you're flat, you get your winners and all that, and you bank it, and then you close your computer down and you're flat and you don't have any open positions, you don't have anything to worry about until the next day when you wake up and you do the same thing all over again. So I can see why high frequency, lower time frame trading is attractive to people, because it's a great way to just sit there and make it your own personal ATM, so to speak. But here's the thing. That's what everyone's thinking. You know what I mean? That's kind of your point, isn't it? That everyone's thinking the same thing, which is, well, I'd love to get into trading because then I could just sit down and make money whenever I wanted to. And what I found is that actually trading is more like a job, like a lot of other jobs, in that, yes, you can get paid for making decisions. Like, you can get paid on the decisions you make, and you can lose money. You can pay for those decisions you make, as a trader, but there still is work involved. So like if I were an algorithmic trader, there would be a whole lot of work in developing and validating my system and running it through different data sets and all of that sort of stuff. And same thing as a discretionary trader, there's a whole bunch of work, that goes into coming up with an idea, testing it, taking a look at the numbers, seeing if you can tweak the exit, doing all this work so that you have some numbers so that it feels comfortable. Whether or not you believe those numbers are going to project in the future or not, that's irrelevant. You just want to get good at trading the system and, feel like, okay, I kind of know what I'm doing here. And hopefully things will hold up in the future. It doesn't totally collapse. So, I can see why traders are drawn to a certain style of trading. They want to win. They want to take a lot of trades, and they don't necessarily want to have a trade that they're hanging on to when they go to sleep. Like, to me, those are the three big ones. Would you agree with that, or are there something I'm missing here?
Yeah, I agree completely.
Yeah, I mean, it seems like that's the thing. Like that's the whole draw to trading, at least in the beginning. But the reality is, for me, and I know this isn't the case for everyone, and I don't think it's a case. Oh, it could be the case for you, where sometimes, or almost all the time, I've got a trade that I've been sitting on for days or weeks, and so it's something that's that I do go to sleep with, and I do have to wake up on Monday morning here over in Asia and check to see if the market gapped against me, and all these sorts of things that I have to deal with as a trader who trades say the daily charts. These are the sorts of things that I have to deal with. I have to deal with weekend gaps. I have to deal with always being in a trade and not knowing what happened when I was sleeping and all that, So there are strategies to deal with that. So how do you deal with that? Well, you take small position sizes so you're not worried about it gapping. You try to avoid getting in on a Friday so that, if it does gap, it's not, ideally it's not going to gap over your stop loss because, you took the trade on a Wednesday instead of a Friday, all those sorts of things. But beyond that, I think it's interesting that by moving to the weekly and the daily charts, it's like you're playing with the unpopular kids. No one wants to play with those kids. They all want to play with the 5-minute charts. They all want to do the scalping stuff. They all want to have the high win rate, quick profit sort of thing. And it sort of speaks to what we were talking about. Like that's where the mistakes are made. That's the mistake. The mistake is thinking that you can make money at this by winning, by having a high win rate, high frequency, low reward to risk strategy. That's the whole deal. I mean, that's how I see it anyway.
Yeah, and I think also it appears to be a less painful way to trade as well, because the reality of holding trades longer is that you get longer periods of drawdown. You have to wait longer for those wins, and they're not evenly distributed wins and losses. Regardless of what your win rate is, the wins and the losses will clump together, and all those elements will be uncomfortable to work through. And your gut instinct is that because you're having those feelings of say being in a drawdown or consecutive losses that is more than your gut feeling tells you is right, then you tend to move away from strategies that have those elements in. And I think those strategies are where the money is to be made. And I've been posting recently with funds that trade longer term trend trading, and if you look at their results over we're talking about 10, 15, some of them even 40 years of results, they go through long periods of losing. And it's a really hard sell to say to someone, look, you're going to take 15, 20 consecutive losses. And really difficult then to go on and persevere with your system when you're in you're in those drawdowns, you're in those periods of losing. And generally what we'll do is we'll say, well, there's probably something wrong with the strategy. So you'll find some way of reducing those losses in the strategy. And it usually is moving your take profit closer to your entry. That's one simple way of doing it. And, you're in the belief there that by removing that pain, you're improving your trading. And that is rarely the case. What you're generally doing is you're reducing the amount of profit you're going to make.
Yeah, and you bring up a good point. I think you can tell, just as you can look at what the retail traders are doing, and I'll put that link in the show notes for people who want to see that link. What percentage of traders are long or short or whatever. I think you can kind of see the same thing. Like as a fund manager, they see when they're in a drawdown and everyone's withdrawing their money from the fund, and the fund kind of shrinks because they're in a 18-month drawdown or whatever. Like to me, that it's kind of like a sentiment indicator, like the same thing that you see with the retail trader, open position ratios, where you can see how many people are long or short the pound or whatever. I think it's the same kind of thing. And it's usually, when it reaches that apex point, when you have the maximum number of withdrawals from your fund, that's when it's going to kick in and it's going to really turn around. The same thing with the media. The financial press will start talking about the death of trend following, like you're saying, like these funds like Dunn or whatever, Dunn Capital in Florida. These guys will often take the brunt of these articles that are written when the funds of these trend following funds in particular, when they have a down period, all these articles will come out and they'll talk about how trend following doesn't work anymore. The markets have changed, blah blah blah. And it's usually around that point when then there's another massive trend, and it takes off, and then they all make money. It's so funny.
This is what they call the dumb money effect, isn't it? Where when something's doing really well, everyone piles in just at the time that it stops doing well, because obviously it's already outstripped its normal performance. And likewise, when a fund is in a period of drawdown, everyone pulls their money out just at the point that the market conditions sync up again, and the big money was there to be made.
Yeah, exactly. Yeah, that's exactly it. Yeah. And there's a really good chart that I'll post too for.
We do that we do that in our own trading all the time, don't we? I mean,
of course,
it's just at that point where the drawdown becomes unbearable that we make the changes, and then the chart conditions improve, and there was your big winners that would have covered your losses and put you into profit. And this isn't only for long-term trading as well, holding trades for a long time. You trade a simple support and resistance strategy on 15-minute time frame with a 3-to-1 or 4-to-1 risk to reward. The elements are the same, just the frequency of your trading is changing. So you might see taking 10 losses in a week as being catastrophic, but those long stretches of losing are always going to occur. And I think the danger is people look at short-term results of people where they appear to not have those periods of drawdown and consecutive losses, and they jump to that different system only for like the next week for it all to fall apart.
Yeah, it's so true. I remember I did a webinar once, and we were looking at the 1-minute euro chart. Oh, I wish I could find this webinar. It was so great, because it was exactly what you're talking about, Darren. And I said, okay, now we're gonna watch this 1-minute chart, guys, and when everyone's convinced, let me know when you're convinced where the market's going to go. Okay, so we're watching these 1-minute candles, and I was yabbering on about some other thing or whatever, and then everyone piped up and they started typing in the comments. They're like, okay, the euro's going up, let's get in, it's going up, yep, uptrend, let's do it, blah blah blah. Damned if that wasn't the turning point. You know what I mean? Like, that's when it fell, and it fell for the rest of the webinar. For the next 50 minutes, the 1-minute chart went straight down, and it was when everyone had said, "Yeah, okay, let's buy the euro now." And it just goes to show that we are. You can use that as a barometer. When, like you say, you can use it as a barometer with a system, a barometer with an individual trade. You can definitely use that to your advantage.
Yeah, I think one of the easiest ways to find how to improve your trading is to look at those elements that feel uncomfortable to you. So let's say your profit target is 3-to-1 risk to reward, And if you always find a reason to take profit at 2 to 1 when you should have held, then that's going to make it feeling uncomfortable to you. And it's that element there is where you're most likely to make the biggest improvements to your trading, and not sort of adding a weird little criteria to the entry or another indicator. That's not where you're going to find the added alpha, if you like. It's going to be in those elements that feel uncomfortable. So you should search them out and make a list of which elements feel the worst to you, the hardest to do, and that's where you're going to find your added edge.
Yeah, that's a great point. Here's an idea, because this is something that comes up a lot. So I'm one of those traders who likes to move to break even, and I probably move to break even fairly quickly. Like a lot of traders don't like, and so what that means is I'll have a whole bunch of trades where if I had just left my stop where it was, then further away from entry, then that trade would have been a profitable trade. But because I moved to break even and then it pulled back and stopped at even, it was a missed opportunity, so to speak, right? Because it went to the target and I wasn't on the trade. Now, that's something that a lot of traders find uncomfortable. If you're a trader that, let's say you trade the 4-hour charts, and let's say that you use a 60 pip trailing exit. So as soon as the market goes, let's say 50 pips, or let's say the market goes 50 pips in your favor, you move to break even, and then you kind of kick in that trailing pip stop. So as soon as it goes 60 plus pips in your favor, that trailing pip stop just kicks in and starts trailing your trade until you eventually get stopped out. Now, there's going to be a lot of times when you're going to get stopped out at a very, very small winner, or get stopped out at break even. And that's going to be really painful for a lot of traders, and they're going to want to fight that. And I think it's because of what you're talking about.
Yeah, definitely. I find that's the problem with trailing stops. The whole idea is that when the market goes and goes and goes, you're going to get those massive wins. But what you find people do is they trail their stop until it does a little bit of a exciting move up, and then they think, oh, well, in this instant, I'll just take the profit there because I don't want it to trail back and stop. They don't like that portion of give back, and that's the problem. And they're picking what's comfortable and feels warm and fuzzy in the moment, but they're missing the whole point of their edge, which is when price goes and goes and goes, then they get a massive winner. And what they'll find they're doing is they're cutting off those massive winners, and the whole balance of their edge and their profitable way of trading is disrupted then, because they couldn't deal with that bit of pain.
Yeah, absolutely. Yeah. So I mean, I think it's a good test. So I think what we're saying here is essentially, if you feel like something is uncomfortable and you want to fight against it, whether it's moving to break even early or whatever it is, using a tight trailing stop, which, by the way, I think the data is pretty clear from what I've seen. Most traders, they give their trailing stops too much wiggle room, and they often have their stop losses too close in the beginning. So they kind of do the opposite of what they should do, which is that the stop loss should be further away from entry in the beginning, and then as the trade goes in your favor, you have kind of a tighter trailing stop. And I think from what I've seen, the data suggests that that's the reverse of what most traders do. They want to get in with a really tight stop, and then once it goes, they want to give it all this wiggle room because they want to be able to survive that pullback and then see it keep going in their direction. When instead they should have just let it pop themselves out. But yeah. So any closing thoughts on this, Darren? I think it's a good point that you can make the largest gains when you're uncomfortable. It doesn't mean that if you're a trend follower that you should be trading reversal trades or whatever, or what is it called? Catching a falling knife or whatever. It doesn't mean you should be doing that. It just means you should be paying attention to what's uncomfortable, because that's probably where you're going to make the largest gains.
Yeah, definitely. And just because something feels right and you're told to trade your personality, that doesn't mean that every element of your trading strategy should feel warm and fuzzy. It's natural for elements of trading for us, for human beings, to feel uncomfortable, and you just need to learn processes to deal with that rather than removing them from your trading completely.
Great. Well said. Thanks for your time, Darren. We will see you next time.
Okay. Cheerio.